C3.ai stock is down something like 75% from its all-time high just about a year ago. And investors are looking at this company thinking, man, this is a AI business. AI is literally the ticker, artificial intelligence for the enterprise. Enterprise artificial intelligence. And so it's got folks excited, but then they look at the price action, they're like, oh my gosh, this is terrible. At this point, if you were to look at the stock, look at the underlying business, is it bargain bin territory, or are you just dumpster diving? Let's dive in to share my personal take. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, folks, the types of stocks that potentially go up hundreds or even thousands of percent over time. So if you're interested in learning about those types of companies, please make a point of hitting that subscribe button. So let's go into understanding what is up here with C3.ai or AI stock. Here's the disclaimer. You can read it on your own time. And so, so I actually do have a little bit of a history with C3.ai. Before they went public, I called it out as a really interesting company. And based on the valuation that they were initially looking at pre-IPO, I was like, wow, there's a lot of upside here. Then, of course, it went public, and I was like, whoa, that's a huge amount of downside. This valuation is crazy. And since then, it's down about 65% from the day after I published this video. So at this point, I think, once again, valuation matters, folks, no matter how you want to cut it. I mean, seeing that sort of decline in relatively short order does sort of suggest a big mismatch between valuation and fundamentals. And two, I want to revisit it as a potential opportunity. So let's dive in to understand that case. And so in order to understand, okay, so what do they even do? A quick sort of rehash. They're early in their evolution as a public company. You know, it's about working with special customers / partners and building their solutions for these large businesses, because these large businesses effectively are key partners in certain verticals. And the goal is, hey, if we can succeed with one of these core businesses, can you then replicate it through the whole industry? So they're in the heavy lifting stage, I'd argue, leveraging huge amounts of data, both internal with the companies as well as external data source, and we'll talk more about that in a second, to create algorithms that can make smart recommendations for very specific industries. Perfect example that I've talked about previously is that they have significant interest in the oil field, the oil industry. Baker Hughes, a major oil servicer, is one of their largest customers. I believe it's around 20% of their revenue, leading partner, leading customer. And by working with them, they get a better inside perspective of all these things that are critical to the oil industry, such as, hey, where do you want to place those wells? Let's have a artificial intelligence, algorithm that has better advice on, oh, this is how you make the most out of these wells. What's the reliability of them? When will they start, falling apart? Or if you're looking at like refining, how do you make the most out of, the inputs and outputs? Various different things where you realize with these industries, there are so many subcategories where if you can have one core customer sort of show you the ropes, you can create a critical industry solution that can be rolled out to many others. Since then, they've also announced a critical partnership with Google Cloud that should help leverage their existing sales force and target small and medium-sized businesses as well. Now, keep in mind, this Google Cloud partnership is in addition to their existing Microsoft Azure relationship, which management is also pleased with, posting up sizable, deals closed. Now, in addition to that, on their most recent conference call, they did call out how they have this AI for CRM, which is customer relationship management, that works with the leading CRM platforms to add better predictive functionality and visualization. So this is taking their tool and layering it on top of Microsoft Dynamics, Salesforce, and all the other different CRM solutions out there. Now, what's critical here is that they're integrating external information, for example, commodity prices or social media or news events. And by integrating that with a CRM solution, they can ideally make better predictive models of which customers might be more responsive to a sale, which ones are more likely to need a price cut, those types of things. You layer in this data, it could become immensely valuable. And these initiatives are starting to translate into much more favorable results. You've seen a significant acceleration in their business. For example, their fiscal 21 revenue growth was only 17%. I mean, That's pretty lousy. Now, I think you can point a lot of this to COVID and sort of responding with their enterprise driven sales force. But you are starting to see real improvement here. You're seeing their customer count grow 85%. You're seeing their revenue accelerate from 17% to 29% year over year growth. That's good to see. Now, what about valuation? I'm going to do a quick plug here. As regular viewers know, I certainly think valuation is important. If you're interested, go to unrivaledinvesting.com, where each month I call out potential multi-baggers as well as my personal financial journey. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So once again, if you're interested, go to unrivaledinvesting.com, click join the journey. Let's keep going. So is this in the bargain bin, or are we just dumpster diving? And continued hefty sales by insiders, by the founder here, the CEO, continuing to sell tens of millions of stock even near the low prices, does not help the bargain bin case, in my opinion, because at the end of the day, they know what the value of a business is. And if they think it's super compelling, I would expect to start seeing purchases, especially after a nice, huge 75% decline from recent high or all-time high for this stock. And Wes, how I look at this business right now, let's see if I can fit myself here. Perfect. So when I'm looking at this business, the current setup around $45 a share, around $5 billion market cap, it really depends on what do you think their growth rate looks like in the period ahead. And I think the risk reward certainly is a lot better than when I previously called it out, where I effectively said 80% downside. Now I'm saying, yeah, the upside that folks are playing for could be meaningful over here. Just a lot depends on their ability to execute. Do these relationships, these deals with a Google Cloud or with Microsoft help them continue to accelerate? They're doing that heavy lifting with these major clients. Will they start rolling out solutions that customers say, oh yeah, we need to have this AI for CRM? Does that become a need to have solution, or is that sort of nice to have and folks are happy with their existing solutions? And so a lot depends on their execution as always. Look, clearly it's good to see the acceleration in revenue. I want to see a few more quarters of continued acceleration for me to start getting excited about it. As I look at the risk reward here, I'm saying, look, long term, this business is nowhere near their current margin structure, because they have something like 70-80% gross margins. Maybe longer term, they could be closer to 30 to 40% operating margins, significantly unprofitable right now. So nowhere near that. But I'm looking at this thinking, yeah, let's see what they grow at over the next 5 years. I'm saying a range of 25 to 35%. Maybe they could do better than that, because they keep rolling out really innovative products. Maybe. There's also an aspect here that I'm not showing, which is that they do have a lot of dilution. They have something like 40 million, I believe, in stock options outstanding that aren't included in their total share count, their diluted share count, because it would be anti-dilutive. So that will further suppress their long-term long-term returns. That is something to consider, given that I'm currently using 105 million shares versus this additional overhang of 40 million additional shares from options. So at what price would I consider, pulling the trigger here when I'm looking at this, based on a range of assumptions, let's say 25 to 30 times earnings multiple 5 years out? I'm saying maybe you're playing for 100% plus return. At what price would I probably consider pulling the trigger on this, or at least revisiting this in a serious way? Like going through all the transcripts, thinking about it. I'd be more inclined to revisit this in the 30s somewhere, where I'd start saying, okay, here's the risk reward starting to become more compelling. But once again, it's hard. You can't just set a price target and forget about it. You have to look at these things as dynamic, and each quarter you're going to have data points that say, oh, okay, here's it's, if your sales growth accelerates, you should be willing to bump that figure up, saying, yeah, they're posting great numbers. So I'm currently, based on their current results, I'm inclined to say, somewhere in the 30s, I'd probably want to revisit this more for my own personal journey. And once again, you can check out my journey at unrivaledinvesting.com. If this video has been helpful for you, talking about C3.ai, the enterprise AI stock, and whether or not it's either bargain bin territory or potential dumpster dive, if this has been helpful for you, please make a point of hitting that subscribe button and hit that thumbs up button. Thanks so much for watching.